All right, we will begin. I am David Edwards, president of Heron Wealth in New York City. We're going to spend about 20 minutes talking about economic situation, pandemic, state of the pandemic. Just a quick reminder, I'm not taking questions while I'm speaking. I am taking questions at the end. I received a couple of questions emailed in earlier this afternoon. There's a chat function and a Q&A function that's part of Zoom. Go ahead and submit those while I'm talking, and then I'll pull those up at the end. So, yesterday, we saw the worst unemployment report in the history of unemployment reports. This chart here runs back to the previous economic recession back in 2008, 2009, that little red squiggle off there to the left versus what we saw on Friday, a loss of 20,500,000 jobs. That was on top of 701,000 jobs lost in March versus 22.4 million jobs gained entirely since 2009, since the last recession ended in December 2009. By comparison, 8.7 million jobs were lost in 2008, 2009. The previous record loss was 2 million, set in 1945. That was the month after the US demobilized from World War II. The unemployment claims actually point to 30 million jobs lost, but the current survey only provides data through April 17th. So just awful. Here's the same view of the data, but now the unemployment rate. You can see two previous peaks, one in 1982, in the middle there, one in 2008, 2009 during the Great Recession. Those peaks were at 10.8% in 1982, 10.1% in 2009. As of February, the unemployment rate in the US was 3.5%. It was 4.4% in March. It's 14.7% as of April. The true unemployment rate is actually closer to 20%, again, because of the lag of data. May unemployment rate could reach as high as 25%. So just awful. We're going to spend a little bit of time talking about current events, and to lift people's spirits, I'm going to start with bad news first and work my way to good news. So the bad news is going to be about the progression of the coronavirus. The medium bad news to possibly good news is the prospects for stocks over the next 6 months. And then actually some good news from my own client families about how they're managing to deal with the coronavirus crisis and make the best of that situation and take care of themselves, take care of their families, and take care of their business. Some really positive news that I got from my own clients this week. So let's jump in here. Last time we spoke was on April 12th, and I mentioned three countries, Korea, Italy, and the USA. And I mentioned that Korea had done a very good job of dealing with the coronavirus. Italy had done a poor job, and the USA had done a bad job. And it's only gotten worse. We have 33% of cases worldwide, 29% of deaths worldwide, but only 4.5% of the world's population. And back in April, I noted that we had 25,000, almost 26,000 fatalities already. As of today, 80,546. By June 1st, 20 days from now, should be at over 120,000 fatalities. People are dying at the rate of 1,500 to 2,000 a day right now. But that number may increase to 3,000 a day starting in June. So as of July 1st, if the rate of death is only 1,000 a day, well, it'd be 150,000 dead people. If it increases to 3,000 a day, 210,000 people. So back in April, I said, yeah, the worst case, we're doing the worst case of any country in the world right now. And with only 22,000 deaths so far, 100,000 to 200,000 deaths is not out of the question. And now that question is answered. Yes, we're going to get there. Let's talk about your personal risk. These statistics are derived from New York State. I don't claim that they're perfect. They are being drawn from medical professionals as fast as those statistics are available. There's a high degree of variability state to state, country to country. But as best I could gauge, out of 10,000 people in New York State, 20% or 2,000 are already infected. Of those 2,000, 25% will actually show symptoms. That would be 500 people. Of those 500 people, 20% or 100 would require hospitalization. And of those 100, 20 to 25 would die. The overall mortality rate, if infected in New York State, is 1.4%. By comparison, the one-year mortality rate for motor vehicle accidents in the USA is 0.01%, which means that if you get infected with the coronavirus, it's 140 times more likely to kill you than a car accident. So that is very grim, and everybody needs to stop and reflect on that for a few moments. I will say that I have talked to a number of clients that have had infections already, and they were lucky. They were younger, they were in good health, and they did not require hospitalization. They were sick, it was not fun, they recovered. I've had a number of friends who have gone through the same process. They've been sick, they have not enjoyed them, they have not had a good experience. It was, as one person described it, it was the worst case of flu he had ever felt in his entire life, but it didn't require hospitalization. But as we know, if you're 50 year older, 60 year older, if you have diabetes, if you're a cancer survivor, if you're overweight, if you smoke, any number of these factors will put you in high risk for hospitalization, and with hospitalization, a high rate of dying. On that basis, speaking for myself personally, we're not going to reopen our office at Midtown New York until September 1st. We'll evaluate the situation September 1st. We may not open it until December 1st. If December 1st comes and goes, we may not reopen until 2021. I have the good fortune of running a business that can proceed completely in the cloud, completely remotely, indefinitely, with no loss of productivity. I'm safe, my team is safe, we're all working as best we can. We've actually added 6 new client families in the last month. That was a record. So we will not be putting our team in the New York City subway system until either we get antibody tests that show we've been infected already, or we get a vaccine. And the antibody tests that are out so far are not reliable. Maybe they will be by the end of the year. And the vaccines, I was more optimistic a month ago about how quickly a vaccine could be provided. Maybe it's 6 months away, 12 months away, 18 months away, 24 months away. So we're not by any means out of the road yet. And when I was talking about the eye of the hurricane last month, I can hear the rumblings of the winds as states open up their economies, people go back to work, people start getting haircuts and tattoos and going to bars again. We will see a resurgence of this disease, and then we'll be seeing 2,000 to 3,000 people dying per day again. And then when that happens, we'll see states having to backtrack and close down again. And with the economic impact on that, it will have some impact on the stock market. I'm going to drop out of the PowerPoint for a second, bring over a website that I consult daily. This is the Worldometer coronavirus website. I don't know why I did that. Let me just, yep, there we go. This is the whole world right now. Those are not good charts. Even switching to log mode, which shows the rate of change, we still see that although the rate of increase has slowed somewhat, it's still going up at a pretty brisk pace, and that's pretty scary. We see in the US of A that we are #1, and not in a good way. 680 people died today. That's actually on the low side. Yesterday, the number was 1,400. Again, that's on the low side. And then we can jump into USA and see if there's any hope of improvement. This is daily new cases. Really has not gotten much better. The good news is that the rate of new cases in New York State and California and Washington, the coastal communities that were hit first, is way down. The bad news is that the rural communities, the red states of America, the central states of America, very much on the rise. So we see no diminution in the rate of new cases. We see a slight downturn in the rate of deaths. I'm hoping that's because we're getting better at keeping people alive once they get to the hospital. But again, we see that deaths come down and come up and come down and come up. And that's not the chart we need to see to feel good about going out in the world. Another way of looking at this is progression in the US. Let me just get to the right page here. I'm going to look at the whole country first. Actually, let's look at New York first. New York was hit first, hit hardest, was first to shut down. This you can see when were schools closed, when were bars closed, when was people ordered to stay home. This is available for each state and for the whole country. And because of that aggressive action early on by the mayor of New York, de Blasio, by the governor of New York, Cuomo, we got past the hump, which was 1,000 people a day, and we're down to 3,300 a day, 400 a day. And if the current trends stay in place, again, we'll see the death rate could be down to 0 by July. Likewise, total deaths leveling off. Let's look at the whole country. So this is not so good. What we're seeing here is that the deaths per day leveled off, came down a fair bit. Most of that is from New York State. Now we're into the phase of reopening major parts of the country. Well, this band here, the lower band is the best case scenario. The upper band is the worst case scenario. And again, it gets us back to that 2,000, 3,000 deaths per day. And if we look at a state like Florida, which has been pretty cavalier about the virus, was late to close, early to open, they may find themselves in a very bad situation as the summer progresses. So if we get to July 1st and the death rate has turned up sharply, many states may have to reverse course, start closing back down again. A lot of people had an artificial sense of relief that this thing was over. They're not paying attention to these numbers the way I am. And when their hopes are dashed, it could be bad. Let's go back to our PowerPoint presentation. So this is a chart of the S&P 500 for the last 5 years. And we've already forgotten that in the fourth quarter of 2018, between September 15th and Christmas time, the stock market fell about 19%. It rallied about 40% through mid-February. When the news of the coronavirus first became widespread, the market had the worst month in about 45 years, fell 34%. I call it the Corona Bear in 4 weeks, 5 weeks. That was bad. And then the stimulus rally, up 31%. Monster rally, stocks going up every single day. Almost hard to believe that you could contrast a 15, 20% unemployment rate with a stock market going up 31%. That's ridiculous, but it happens because of what we call the Bundy Quarter Vet. To make a new high from where we are now, the stock market would have to rise about 15%. That's about a year or 2 years return under normal circumstances. But if we get to those death rates going up again, July, August, September, is when I fear it will be the worst. Then the stock market may come back down again and touch those March 23rd lows. And so let's talk about what that means for our clients. We've been working flat out for the last 6 weeks with all of our clients, and everybody has a different situation. For the clients whose businesses were very much in jeopardy, we raised cash early on. Some of those clients have come back already and asked if we should start reinvesting, and the answer is no. We're going to wait and see. We did invest a number of clients during the Corona Bear as stocks were falling. We bought stocks because if stocks are on sale, you should buy. And so now we've made a little bit of money there. Not eager to add to that right now. For the most part, I feel like I've spoken to every client that needs their portfolio adjusted. However, if you have not spoken to me and you feel like an adjustment is in order, call me tomorrow morning, first thing, 8 a.m., 917-705-3893. And if you're not a client who has not worked with us before but would like a second opinion, you can also call 917-705-3893. I wanted to end with some good news. There's been such bad news of the last 8 weeks. You know, you always see Depression era pictures of people standing on bread lines, people selling apples, things like that. And you just never could imagine that that would be a modern experience. And yet, if you flip on the television, you can see people in cars waiting for hours to pick up a basket of food for their family. And the impact has been completely unfair how it's landed. Most of our clients are upper class professionals, they're business owners, they have financial resources, they have families that can look out for them. And you know, I've talked to as many people as I could. I haven't heard one client yet who is in deep financial distress over the situation. They're not happy, but they're not really impacted adversely. But also, I was most worried about our clients who are business owners. I'm a business owner. I have a payroll. I have rent to pay. I have team members that I care about deeply. And I know what it feels like to wonder if you have enough money for payroll. I wonder if you have enough money for rent. So 4 weeks ago, we hustled around and made sure that all of our clients knew about the PPP program from the SBA and were able to reach out to their banks and file an application. And I've heard pretty much every person got funded. I have not yet heard from one client that did not get funded. So that's really great news. But the other bit that makes me feel good is how our clients have reacted. So the world has changed, and it's so tempting to just crawl under your desk and pull your hat over your head and cry. And not one of our clients has done that. You know, one of our clients has a big landscaping business out in the Hamptons, and he was looking at having to close down his entire business in one day. But he got on the phone and he spoke with the East Hampton town people and was able to get his business designated as an essential business, landscaping, with certain restrictions, and keep his team on the road and working and keep his payroll going and keep his money coming in. But he got his PPP loan. So now he has a big reserve in the bank in case things turn badly later. We have another client family that provide technology. They provide technology to us, all of our cybersecurity and remote work. And they may have a banner year because so many businesses have discovered how important it is to be able to support your team remotely. And then finally, the family I was most worried about runs a chain of beauty salons and spas in Long Island. And I was just so worried about them because you can't have a beauty spa during a coronavirus pandemic. You just can't. But luckily, they had a new business they had just started up, and it's an office maintenance business, and they had one sprayer that is for disinfecting surfaces, and they hustled around and got a crew out on the road almost 24/7. And they haven't replaced all of the revenue from the spas, but they've replaced enough revenue from the spas to keep themselves clothed and fed and housed. And they also got $600,000 from their PP loan, which they've stashed in the bank. And so 6 months from now, or 9 months from now, or 12 months from now, when they have the opportunity to reopen their business, they will be able to do so. And I just am so proud of how hard our clients have worked in this really tough time. And I'm also really proud of how hard my team has worked in this really tough time. I only had, I think, 1 day off in the last six weeks. I think my team has been working equally hard. We have not lost a beat. We have not lost a client. We've added 6 new clients. We have done our jobs in really tough circumstances, and I just am so thankful. And I'm sorry, I'm getting a little emotional here. I don't usually get emotional about anything, but I'm just proud. I'm really proud. Let me wipe my face, and then let me turn to the chat and get some questions in. And I'll start with 2 questions I got in by email earlier today. The first question was somebody asking about real estate values. Real estate is an extremely localized question. So in New York City, for example, real estate values have been heading down for the last 3 years anyway, having to do with overbuilding of luxury housing and some changes to tax laws. And right now, a lot of people are thinking, you know, I need to get out of New York. I need to sell my place, move to the suburbs, move to the exurbs. So New York City real estate was under pressure before. Now it might really be under pressure for a while. And that's just how it's going to be. Maybe property in the Berkshires will be more interesting to people right now because it's far away from other people. So I don't have a good solid answer for that. It's a case-by-case basis. Don't have a good answer on that one. The next question was somebody wanted to know why financial service stocks have not done as well as other sectors right now. The 2 worst performing sectors right now are energy, absolutely crushed. $2 gasoline, anyone see that recently? Amazing. But banks are under pressure for 2 reasons. Number one, there may be a lot of defaults heading their way. People not able to keep up with their loans or their bonds or their debt. But the other thing that hurts banks is 0% interest rates. If interest rates are so low, banks can't make a net interest spread to make profits. So banks will be under pressure for a while. They're not going to go bankrupt. They're not going to go out of business. They do have the Federal Reserve backing them up with trillions of dollars of excess reserves. You know, when I think about how hard it was to get support for the banks back in 2008, 2009, oh, it took like a week this time around. It was super fast. I'm going to check a question that just came in, or perhaps it was on chat. I saw someone raised a hand. Here's the question. The question had to do with, is there any way to return an inherited MRD for 2020 that was already taken out? We've actually had this question on a couple of clients already earlier this year, so we had a chance to research it. And the answer is there's a 60-day rollover provision. So normally we take all our clients' RMDs on January 15th. RMD is a required minimum distribution from an IRA if you are 70 and a half and older, or as is now 72. So if we took your RMD out on January 15th, it's too late to return it for this year. A couple of clients get their RMDs at mid-year or monthly, and for those clients, they have the option of suspending the distribution for the rest of this year. And those clients that have asked us about that already, we've already done it. If you're in that situation still, the person who asked the question, I don't think is a current client, give me a call and we can explain how it works. Got another question about how about the renewable energy sector? I think the renewable energy sector was on the upswing before the coronavirus pandemic, and I think it will continue to do well over the next decade. It has nothing to do with the coronavirus and everything to do with economics. With each passing year, the cost of generating electricity from a windmill or an offshore tidal farm or from solar gets cheaper and cheaper and cheaper. And the cost of extracting oil or natural gas or coal gets more expensive, not only from pulling it out of the ground, but also from the obvious damage it does to the climate, to the environment. And I feel like I saw the tipping point this this winter, I was flying back from Utah, and the plane came in over the Great Lakes. I was looking down, and as we passed over the Great Lakes and over Michigan, I looked down and I could see farmers' fields for hundreds of miles, and every single one of those farmers' fields had a windmill in it. So practically the only thing that's holding back wider adoption of renewable energy at this point is how sclerotic and out of date the US energy grid is. And once that gets fixed, yeah, I think the days of fossil-based energy is pretty much over. We didn't run out of it. It just became better and cheaper to use electricity. And I don't have any more questions on the Q&A. I will check in the chat room and see if anything came in there. How will massive unemployment affect the markets? Is there any historic reference to help predict? So time and again, we've talked about what the stock market cares about. The stock market only cares about revenues from companies, earnings from companies or profits, and interest rates. So right now we have 0.0% interest rates, and that is very supportive of the stock market. Revenues are down violently. It depends on the industry. If you're an airline company, they're down 96%. If you're a cruise ship company, they're down 100%. If you're a hotel chain that depends on revenues from Las Vegas, they're down 100%. But that will start rebounding next year, and as revenues rebound, so do earnings, and that earnings is what ultimately drives the stock market. Having said that, I think the stock market rallying 30% from the March 23rd low has gotten way ahead of itself. And so we're not eager to put more money into stocks at this point. We're not taking money out of the stock market. We always have this conversation with our clients. Is this 5-year money? Is this money you don't need for the next 5 years? If that's the case, it can stay in stocks. If you need it for the next 1 to 5 years, we'll put it in bonds. If you need it in the next 12 months, we're going to put it in cash. We're going to put it in your checking account. You know, we will be looking at this thing in the rearview mirror, I'm going to say 3 years from now. And we're going to be looking at it from the perspective of a huge rally as the country goes back to work and as we address the obvious flaws in our healthcare system, our infrastructure, our security systems, right? So I hope there's a different administration that's up to that task. I don't think the current one is. I am going to stop now. It is Mother's Day. I always seem to pick a day when people would rather be with their families for these webinars, but they are news driven, and the unemployment report on Friday was a very important piece of news. So happy Mother's Day to all the mothers out there. I talked to my mom this morning, and I wish you all well. Good night.